Welcome to this week's Market Matters video update. I'm Harry Watt, joined by James Gerrish on Wednesday, the 2nd of March. Today, 2 days into the new month of March, we're going to talk about February's performance across the suite of portfolios we've got at Market Matters. So kicking things off with the flagship growth portfolio. James, how did that fare in the second month of the year?
Yeah, so reporting is obviously dominating the period through February. So February's a busy time, and it's always nice to get an update on the companies that you hold across our portfolios. Obviously, it was local reporting season, but we also had the back end of quarterly reporting season over in the US. So we come away from it going, being able to understand how our portfolios and companies are performing. So the flagship growth portfolio was up 2.1% in the month of February, so a reasonable performance. The market itself, inclusive of dividends, was up about 2%, so in line with the market. If you think about overseas markets versus our own, we actually had some strong outperformance in the Australian market during February. So US stocks were down about 3.5%. So some underperformance from the overseas stocks versus our own. That sort of reverses the trend that we've seen in the last couple of months. So the Aussie market up 2%, and our portfolio, the flagship growth portfolio, up something similar. Commodities really the key in terms of that outperformance, the performance in that portfolio.
Definitely. Income portfolio. It's a big month reporting season for the income portfolio in particular. Figure out how much the dividends we're actually going to receive that were first what we were expecting leading into February. How did that portfolio go?
Yeah, this portfolio is all about consistency in returns. So some capital growth, but really around the consistency of dividends. We target more value-orientated stocks, so not your high beta, growth type businesses, which is the tech companies and the like. So in February, the market gravitated towards those stocks. So this portfolio did really well, up 3.91% for the month. If you think about the composition of the portfolio as well, so it's less than 70% exposed to equities, and it's got the rest in fixed income, hybrids, and the like. So it's a smaller exposure to the equity piece, and outperformed the market pretty significantly over that period. So really happy with the performance. We had a couple of stocks that did really well during reporting. So subscribers would have got a performance update this morning on a weekly basis. But I look at Service Stream, IVE Group, which is IGL ticker. Those stocks are up over 25% in the past week alone following their results. So really happy with that portfolio, the consistency in returns, and the outcome for February. So onwards and upwards for the income portfolio, Harry.
Definitely staying local, staying domestic, finishing off with the emerging companies portfolio. James, interesting time for small caps. They definitely underperformed. How'd the emerging companies portfolio go?
Yeah, it was a difficult period for small caps generally. So, and particularly in the emerging companies portfolio, which you're charged with running, it was down 5.7% for the month. Which is, you think about the backdrop, and we've had a large rotation out of some of these higher growth, mid-cap stocks, particularly stocks that are exposed in the payment space. So we go through the portfolio, and we spend a lot of time going through the portfolio this month, testing our thesis on a number of these positions. Where I say that a number of these positions have, the companies have actually improved somewhat, even though the share price hasn't been reflective of that. Anything that is more is burning more cash than the market anticipated, or margins are lower than the market anticipated, got hit really hard. So, notwithstanding a couple of positions we're really disappointed with, I think the portfolio, coming out the other side, it still seems pretty solid. So, a poor month for the emerging companies portfolio. The market was soft in that area. But again, we'll continue to tweak that portfolio, but reasonably comfortable with our positioning.
We looked at one tweak this morning in the AM report. Going international, the international portfolio, you said the international, particularly US indices, underperformed versus our market in February. How did that portfolio go?
Yeah, so against a backdrop of, say, the US market down 3.5%, the international equities portfolio was down 1.4%, but that also included a negative a negative flow from the currency, so a negative influence from the currency, I should say. So the currency took more than 1% off that portfolio return. So it was a flat month, if you like, ex the currency for the international equity portfolio against a market that fell more than 3.5%. So reasonably comfortable with that. And then the macro ETF portfolio, which is sort of split between Aussie holdings as well as international holdings, showcasing our top 10 macro ideas at the time. That portfolio was up marginally, so it was up 0.24 of 1%. So up marginally there. With some of our, if I look at that positioning, our energy exposures benefited. So that being the fuel ETF, which we're actually liquidating in the market today, and the uranium Sprott Physical Uranium Trust did particularly well. It was up 11% in the month, offset by a positioning towards Europe. So European facing ETFs struggled during the month, and that took some of the performance off the ETF portfolio. So a reasonable month for that in a pretty choppy market condition.
Definitely. That wraps up the 5 portfolios, James. We've had a good day on the market today. It's bouncing out of lows, so we'll get back to buying some stocks there.
I think it's an interesting point, because we wrote this morning that there's a huge amount of negativity coming through the media, and the words. It's hard to put in the words the atrocities that are happening over in Ukraine, and our heart goes out to all that are affected by that, as well as the floods that are happening up in the northern part of the country. I mean, you sit back and from a market's point of view, and I feel it's always when we sit back and remove ourselves from that and look solely at markets, the market is actually showing a fair amount of resilience. Now, that's obviously, we've got the negatives from what's happening on the geopolitical front, but then that's partially offset. There's been a big about turn in market expectations around interest rates this week. So, instead of pricing a 50 basis point increase in the US Fed funds rate, the market's now stepped that back to 25 basis points. So you think about, there are always macroeconomic offsets to the headlines that you're reading in the newspaper. So always keep that in mind when you're looking at all the doom and gloom from a market's point of view in the mainstream media. So thanks for joining us. We'll speak to you again soon. Bye for now.